February 7th, 2013. Episode 7, Part 1, Economics and Trust. As always, welcome, and hopefully welcome back. Also, if this is the first time that you've ever heard me, and you like what you hear, make sure to go by the website at mad-yet.blogspot.com. There you'll be able to find simple and easy links to our material on Facebook, Twitter, YouTube, and on iTunes. Now let's go see what I had to say in my new article. Economics and Trust. In this week's article, I want to focus on economics and trust and why they are so important. Economics are a part of our life, from the time we wake up and brush our teeth with the toothbrush that we purchased, to the time we lay our heads down at the end of the day on the pillows that we've purchased. But have you ever asked yourself, what is economics? Or, how does it affect me? No, more than likely you never have. Also, these are things your parents probably never asked either. This is because schools, increasingly since the mid-1800s, almost purposefully neglect to teach these things to children in what many consider to be a conspiracy to dumb you down. So let's do a quick review. What is economics? The definition of economics is the social science that analyzes the production, distribution, and consumption of goods and services in any given area or segment of society. Economics are important to everyone, from the candy maker to the Wall Street stockbroker. There are fundamentals to economics. These fundamentals are known as supply and demand. This can be analyzed easily using what is known as fundamental analysis. With that being said, let's go over what supply is. Supply is defined as the amount a product a producer is willing and able to sell at a given price, with all other factors being held in constant. Basically, this means how much product is available to be sold without changes in a given marketplace. But, as we all know, markets change. Think of it in these terms, for example. When the copper sword became cheap and easy to make, the sales of spears probably declined. People aren't going to pay more money for an object that has less value. Now, let's go over what demand is. Demand is defined as the economic principle that describes a consumer's desire and willingness to pay a price for a specific good or service. Basically, this means how much product is desired to be sold, or more simply put, how bad do you want this item? Now let me be clear. The fundamentals haven't been working due to government intervention and clear, some would say blatant, manipulation of the precious metals markets, bond markets, combined with other scandals. Due to these factors, our economy has been undermined, some would say purposefully. We are being manipulated by the too-big-to-fail banks and other greedy corporations. These types of problems only lead to one conclusion: the collapse of a system that is fundamentally flawed in the first place. Ironic, considering these banks and corporations are now bigger than they ever were before, even after the economic crisis of 2008. All thanks to your tax dollars filling the pipeline full of easy money to siphon off. Let me illustrate my point by making sure we understand what manipulation means. Manipulation, or more accurately, market manipulation, is described as the deliberate attempt to interfere with a free and fair operation of the market and create artificial, false, or misleading appearances with respect to the price of market for a security, commodity, or currency. Basically, markets have their own natural forces, and anyone trying to alter those forces on purpose is going against those natural forces. This means someone is tinkering with the natural order of things within the free market economy. Now let me give you an example. If you want to build a table and you need 10 screws to finish your project, and you don't have any, you must either make or purchase this item. Let's assume that you don't have the ability to fabricate those 10 screws. You would have to go to the store and purchase those screws. In a manipulated scenario, you tell a friend you're going to the hardware store for the screws to finish your table, who mentions your need for screws to the owner of that hardware store. The owner of that hardware store then decides to empty the screws from the bins to a nominal level and inflate the prices by 200% to make a higher profit than normal, and happily sells them to you. As the consumer, you see the price, but you don't realize that the hardware store owner just manipulated you into paying more, because you didn't know what the price was before. Even if you did, he had the only screws in town, making him a monopoly on this item. Now understand, the hardware store owner had tons of screws, and he will simply put more screws back into the bins when you leave. But he did this merely to inflate the price and make more profit. Don't like this type of manipulation? This type of activity happens more often than you know. Is profit bad? Now, from a business perspective, this is profitable, and the main goal of a company is to produce a profit. So if there was a way to predict when a customer's demand was going to increase on any and all items they produce, it would be in their best interest to gather that information quickly and aggressively. It is the simple nature of business. And if you have a smartphone, you should realize this is being done to you right now. Profit is derived from greed, and greed is good, according to Gordon Gekko. This is a character created by Oliver Stone and portrayed by Michael Douglas. This character and the movie he was presented in was a wake-up call for many Americans. Mr. Douglas's Oscar for his portrayal of this character goes to prove that point. I mention this Hollywood example because I think this is an example that will resonate with you. Now take this character's greed is good speech to a crowd in this movie and chew on it. Let it simmer in your skull for a while. This seemingly innocent glorification of a greedy and unscrupulous type of investor was what many in America strive to be for many years, and some still strive to be. See a problem yet? If not, you may if you ever have to deal with a foreclosure, the loss of an IRA, 401k, or some other form of pension that you spent your entire life building, only to lose to one of these vipers. How does this affect you? Simple. Every day billions of dollars are printed. Every year, trillions. This unilateral overprinting of dollars out of thin air is devaluing its intrinsic value without any external help like war or civil unrest. Never mind that the currency is backed by absolutely nothing in the first place anymore. Our money used to have a set value because it was linked or backed to commodities like gold and silver in the past, but no more. The US dollar used to have a set value because the world trusted that America would keep their word and honor the Bretton Woods system of finance that the world's leading nations agreed on in July of 1944. The world had faith that the United States would never break its word. In hindsight, their trust was misplaced, but it made total sense to many in America and abroad, since the United States economy was founded on the silver standard, which used the silver Spanish mill dollar in 1785 during the founding of this nation. To many, this linking of a currency to a hard asset was considered a healthy thing to do. Due to this, we codified the Coinage Act of 1792, and we linked our economy to a commodity, silver. For the first time, we had our own money, and that money had value. Today's money doesn't represent value in any way, due to the massive overprinting of fiat dollars by the Federal Reserve's actions. In fact, in today's society, a banker can simply click a few zeros into a computer screen and have more wealth in a matter of seconds than your entire family could produce in a lifetime. And this worries many in financial circles. And realize, the use of the term worry is a massive understatement. Several things had changed since the Coinage Act of 1792. Wars, civil unrest, and the Industrial Revolution, and several other factors caused the national economy to change over the years. This is natural, but due to these changes and several other reasons, we allowed the Federal Reserve to take over the printing of our money. This is widely considered a pivotal change for the worse in national economic sovereignty. The history of the Federal Reserve is stricken with many claims of fraud, conspiracy, and secrecy. G. Edward Griffin has what I and several others would undoubtedly say is the premier accounting of how the Federal Reserve was established in his book, The Creature from Jekyll Island. He states that the Federal Reserve's very establishment was created in secret, on an island, behind closed doors, and that the men involved in this meeting denied for years that such a meeting to establish this new Federal Reserve system ever existed, until after it was implemented upon its intended victims, you, the American citizens. Now, I won't go into who was there, why they are important, or any of that in-depth analysis, but I highly suggest that you watch and listen to the videos in my article. These videos will clearly explain that there was a plan and outright conspiracy to loot the wealth of the American people. They will also point out that such a system doesn't benefit you in the long run. It also clarifies that the Federal Reserve System is a criminal and fatally flawed concept that is a perpetual debt machine. Unfortunately, we and many other countries in today's world subscribe to this fractional reserve banking system of economics, and it's starting to show cracks in its foundations. What is fractional reserve banking? This is the most important question you can ask anyone. Try asking your local banker. Enjoy the look on their face when you ask. I always do. What if I told you that your bank doesn't have your money? That's right. Imagine if you're a hard worker, a staunch saver, and a dollar-stacking fiend, and you have all of your money in a safe, in a bank, somewhere. What if I told you that that money wasn't really there? Would you be angry? You should be. Let me explain why this is exactly what is happening. The reason your bank doesn't have your money is because it's loaned out. See, banks have to loan money to make money. They are allowed to lend up to 90% or more money than they have on the books in many cases. This changes due to economic climate, but the premise is the same. They lend what they don't have. The more they loan, the more they make in interest. But they never really have that money to begin with. Pretty sweet deal, huh? They are legally allowed to lend more than they have. Sound like fraud? It is. Throughout the history of the fractional reserve system, banks have lent money to make money. It's how the system was designed to work. The one thing that ruins the fun for them is when you take your money out of the bank. When you do it, it's considered an inconvenience. But when several people or a nation full of people pull their money out at the same time, it's called a bank run. And this is a nightmare scenario for all bankers. This is the end of part 1. Please check my channel for part 2. If you like what you hear, make sure to drop by our Facebook and our Twitter page, give us a like, maybe a follow. Make sure to get this word out. Thanks for dropping by and keep checking in.